can begin. All right. Okay. Uh, so this is a multimillionaire forum. For the ones who are coming for the first time, what this is basically an endeavor for us to get connected with everybody, just talk about generally what's happening. We don't speak about any products or any recommendations. We generally speak about what's happening in the stock market, bond market, gold, etc. If you have any of those questions, we can always talk in generality about it. But otherwise, this is much more like an information and educational sort of essential kind of a necessary service from our side. So it just helps people to connect, also learn about a few new things that are happening. So that's about what this whole idea is about. We try and do this on the first Saturday of every month without fail. We try and have one session. It's a great opportunity for some of us to just see each other and also say hello, if nothing else. So that's the whole idea of what we're doing here. All right. Okay. So let's move. Let's start. Let's go to the next one. So what are we talking about in terms of financial planning for our children? Essentially, what is it that we want? So can you stop slideshare? I'll just tell you. Yeah. Thank you. And can you make it speaker view? And can you pin it?
You unpin, sir.
Okay, thank you. That's good. So, what we tend to do for our children is we want to give them, of course, the basics, the education and, a good life, a good housing. All of that is just very, very normal. But there are very different sort of reactions that I have seen in the last 10 years from different people. So all of you have kids, so if some of you can just, unmute yourself, like I said, and share with me, what is it that you want to do for your children? I mean, of course, the basics are there. Schooling, education, foreign education, housing, maybe gifts and cars and, all the niceties of life. But other than that, what are some of the main objectives that you all have for your children? Anyone, please feel free.
Able to do whatever they want to do.
Sure,
and not to do it because they are compelled to do. So maybe that kind of a financial freedom. So educate them also and obviously keep something for them. So,
yeah, basically give them the freedom of expression. Let them go ahead and pursue whichever life and career that they want, which is great, Apurva. But what I want to go is like one step deeper in the sense, what do we want for them? What kind of a life do we want for them? Financially speaking, or it could be just generally living a life, which is with some values or with some ideology. I mean, what is it that we want to give to our children beyond letting them choose what they want and beyond providing them whatever they wish for?
Kartik, so I would be saying that I have a daughter and she's 3.5 years old. So
yes,
on broadly speaking, values and ethics, education, life skills, and one of the key things which I feel very strongly is resilience, independence, and responsibility. These are very hard words, but to be honest, to pass on this. Very good culture. Like if we say that we normally do ask our kids not to go for a digital thing, don't watch TV and all. But as a parent, if I'm glued towards my mobile or my laptop, that is not something which so I need to make sure the conscious effort that what I'm trying to pass on. So I need to behave that ways. As Gandhiji said, that how you want to see the world, you need to behave that way. So that's what I feel like. That is at least are with my own kid and pass it on. And there are many other things which, as a parent, we always want our kids to, they should get this and that as well. But these are the basic things which I feel, and the real kind of empowerment, if that could be there. So.
Yeah, absolutely. I mean, I've also seen so many of us sharing that, we would like them to become better decision makers. We put them through a lot of classes and things like that. But we also want to do something which, builds their personality, because they will only be a reflection of what they are doing at that point in time. So they are hanging out with a set of friends who are, let's say, all, enjoying themselves, going to clubs, being on their mobile devices, whichever age our kids would be, from 3 to, let's say, 30, in that range. So we would like them to, follow a different lifestyle. Very often, I have also seen that, as parents, we do a lot of financial management for them. But very often we feel that, kids are absolutely not connected with us in terms of our thinking and our methods of doing. Their thinking is radically different, not because of generation, but maybe because everything's already provided for. So the responsibility that we had to create assets and create a future for them, maybe they don't see it that way. Has anybody come across things like that?
Not yet. My
Not
kid,
yet.
my daughter is young, so
Much
she
young.
follow. In fact, she just sees me and she's trying to, um, you know, follow my footsteps into many things, trying to do many things and all. And
Correct.
I keep telling her that you have to do whatever you enjoy, you do it, but you do it best and try to create some positive impact on the society in some
Yeah.
way or the other.
Yeah, that's right. I think all this is so important, because while we give them all the means to spend the money, what also we want them to do is, learn some of these other values of life. Go help some other people, try and do some nice things. Go ahead and make a little bit of a different kind of a image and name for yourself. My daughter basically joins something called Changes Us. So they do a lot of work, social work. They do beach cleanups and things like that. Small things. I think it helps. And while we are instilling all this financial discipline into them, we are also under pressure. I was very recently, I was just out with another cousin over dinner, and then we were just generally talking in terms of the expenditure that we are having. And I was visibly a little surprised also, a little shocked also, because people want to do the best. They want to spend a lot of money, which to a certain extent, beyond a point, is seemingly unrealistic also. But we spend a lot of money on schooling. Then obviously, because you spend a lot of money on schooling, right from preschooling to schooling, then naturally the higher education, even the child gets used to the fact that I want to have the best of schools and the best of education, which is going to be the most expensive education. So, so having said that, one of the things that I found over the last 30 years is what people actually do. So now we are moving, from behavior and everything else into financial activities. So in terms of financial activities, these are the things that people want to still do. Some things which is 100% guaranteed. Let me go into Sukanya scheme. Let me do a fixed deposit for them. Let me do bonds for them, etc. I know a lot of you are obviously investing into equities. So over a period of time, our thinking has changed quite dramatically. But I still see this as one of the major, influencers in doing everything. So while what happens on one side is that we want to create wealth for them, on the other side, we are investing into products which have a very fundamental problem. And I want to show you a glimpse of how fundamental this problem is. All right. So let me just sort of share another screen with you. Um, and here it is. So, what I've done is this is just a very simple sort of an image which basically shows you exactly what's going to happen with the strategies that we tend to follow for years together. So this is just a comparison between PPF and let's say an MF in a very simplistic format. This line up here is obviously the MF, and this line, the red line here, is the PPF. Okay. So I'm just going to take a realistic example. Say we have about 5 lakhs, which we, as a fund, we have this much money, and we were to invest the same amount in a mutual fund. See, the difference over the years is staggering, right? Because if we had to fund fees which are 2 lakhs and 3 lakhs for schooling, and then for higher education, when the fees start becoming 8 lakhs and 10 lakhs in a year, and then for international education, they become even that much more expensive. The difference, we don't realize that initially in our years, because typically when we have kids, we are around the age of 30 or so. And then from 30, we basically, by the time we move to 40, it still isn't impacting because we're still earning. The pressure really starts coming in when the kids start becoming 15 years and things like that. And that's the time our age starts becoming somewhere in the range of 40 to 50. And then, expenses escalate. So this is the time we really want to have a much larger sort of a collection of corpus, or let's say a much more fund that we have to be able to fulfill these needs. So this was just to bring out the impact is humongous. Now, if I take some monthly examples, a lot of us do SIPs also, right? So let us say we were to do 12,500. Because why I'm saying 12,500 monthly in a PPF is because we get our Section 80C deduction. It's not going to last very long, but so long as it lasts, let's say we are enjoying that. So 12,500 a month, that's 1,50,000 a year. Now, if we were to do the same thing in a mutual, which basically we have taken 12%. Yeah, it's a very, very sort of conservative type of a return. But again, see the difference. This is a 30-year difference, right? On a 30-year basis, it's staggering. Let's make it even more realistic. Let's say, let me add that 5 lakhs back into it. So assuming that I just have 5 lakhs for my child right now invested somewhere, and then I'm doing this 1,50,000 a year. What's the difference that I will land up with in about 30 years time? So with a PPF strategy, I'll end up with, as you can see, 19 million or 1.96 crores. And as you can imagine, the mutual fund number is almost 3 times that number, which is 5.78 crores or 6 odd crores. So that much is the impact, and that much is the difference. Is this okay so far? Is this understandable? That, I mean, this is a serious sort of problem, because what we are doing on one hand is we are trying to do a lot of expenditure. We're trying to put them in the best of schooling, education, foreign education. But on the other side, our investment strategies are rather constrained and restricted. Does that make sense?
Yes.
Yeah, a lot of times. So I just want to take a little deviation here, talk of a slightly different kind of a concept. What happens is, Newton's law, what we have learned in our school, that every action has an equal and opposite reaction. So what I'm saying is, with this law, we have learned this is what our parents did. We do the same thing. We do the same thing. We expect our children to learn the same thing. So what happens in this whole procedure is that whatever has been happening, we will continue to do so, even the law of inertia. But what Newton's law says, or rather what it does not say, is the quantum side of things. That on one side, like somebody just posted, we think that a 12% return is possible, but on the other side, we are not very, very sure whether this 12% will happen or will it not happen. Tax is a different story. We don't know what is going to happen in tax. Today, the tax could be 10%. In future, the tax could be something else. So what I'm trying to say here is that, yes, on one side, there is this thing that we continue doing what we are doing. On the other side, if we take a very, very different stance in life, then we can suddenly see that we move into a different zone. Wealth is larger. We are able to meet further expenses. And it's not only that, there is a belief factor also, which I will come to in a little while, saying that if on one side we are creating these funds, the other side, for these funds to actually happen, the projections to actually work out, it's a little bit of knowledge plus belief and plus a little bit of faith also that these things will actually sort of work out. Can you have the slide back, please? Next one. So far, so good. Is there any confusion, any clarity required on the fact of how big this problem is? The problem just becomes very, very wide and very, very large as we sort of move in terms of time. So, yeah, Lokesh, very true. What if a situation like COVID comes after 20 years when my child's education comes? True, I can answer that right away. So what happens is, even the graph that I showed you, right? The graph that I sort of mentioned about, let's say this was the graph, don't mind my drawing, but this was, let's say, the mutual fund, and this was the PPF, that kind of a thing. This graph is exactly not going to be so smooth. It's not going to be so clear. So in reality, let's say the graph that we are going to have from a fixed income is going to be pretty smooth, but from the stock market, it's going to be like that, right? Over a period of time. This is how it's going to go. Now, what happens is, we do make some plans, and very soon we are going to show you a little template also to how you can actually maximize this. The idea is, if you need the money, let's say at this point in time, okay, and this is, let's say, when my child is 15 years old, okay, I will not exactly come to the 15-year point and then think of what to do. I will start thinking from year number 12 or year number 13 or 14. of the age. And we will do things that we need to do from this point. We don't wait for the last minute to happen. Okay, now let us say that we were in 2020 and we had to do something in 23, and something like this COVID just kind of happened here. It was just an absolute jolt. It happened. We couldn't do anything about it. Well, the little solace here is that you're not going to need all the money. Say if this budget was for international education, okay, and where let's say the estimate that we had to spend was going to be, let's say 50 lakhs, just as a simple example. Now the entire 50 is not utilized here. It's utilized at a point in time. This will go down for the time being, but we've also seen that this comes up in the same time. But this, therefore, cannot start at this point. This should have started from here. That's the beauty of it. And that is exactly what I'm going to show you. Jhaveri, can you move on, please? Now look at this. This is part of my own portfolio. This is my daughter, okay, Anika. And just let me stop and okay. Clear. Stop. Okay. So as you can see, this is live portfolio as on yesterday. This is me. This is for my daughter, like I said. This being an education thing, obviously in office, I'm very happy to share all these investments that we have. But look at the investment time point. When was this thing done? This was done in 2012, 31/12/2012, right? So obviously it's run for so many number of years. Almost this is 10 plus years, 3832 holding days. See the returns that we're holding on to. Now, one point of time, this was tax-free. Recently, taxation has been applied on all these funds since 2018. Equity has become taxable. So what's going to happen is we're going to lose 10% of these gains. So be it. That's a part of life. You can't really do anything about it. Eventually, what we want is that we want to see this number grow larger and larger. This is an investment which was done in 22, returns being 15/20. This is very recent, so not really worth talking about much. This was again done in 14. This is almost going to complete 4 years next next April, 1464. This was done in 19, about 4 years ago, and this is turned out to be a very good investment, 27% compounded. And this is what I'm talking about, XIRR, compounded rate. The beautiful thing in all this is this single number, 1874. So this is live, this is happening. So this is happening for an investment time frame of about 10 to 15 years and more. And this will continue happening. So Lokesh, your question about what happens at a time if COVID strikes. Now, COVID has obviously stricken in this whole period, right? This investment was affected by COVID. This one was affected, and so was this. This investment was just 1 year old. It was done on 11th of February 2019. And then within about 11 months from there, 13 months from there, COVID struck us in March of 2020, isn't it? So this investment would have definitely gone down, but then it also sort of came back. And today in June 23, 27% is the compounded rate of return that we are seeing. So these things are very easy. They happen. But like I said, Newton's law, we have been taught that, stock market is a place where you lose money. You put in something, you'll lose something. But somebody did not tell us that in the stock market, there are two things. And this might seem really weird. Can you stop the screen share for a minute? This might feel completely ridiculous and weird to a lot of you. At some point of time, I will actually document this thing. In the last 20 years, I have seen professionally managing so many, so many investments of so many people. There is a pattern, there is a profiling that I'm intending to do of who actually made the maximum returns from investments. And when I'm saying investments, I'm not only talking about the equity market investments, I'm saying investments as a section of your life. So earning professional income was one section of life, earning investment income was the other section of life. And then earning other, rental incomes, royalty incomes, we'll not talk about all of that. But all these people who actually made a lot of money had a few common things between themselves. So when they started with a small amount of money, obviously, because that's how everybody starts. Then they kept in a very solid financial discipline. They kept doing it again and again, which was great because that helped them build the investment part of the corpus or the capital, if you like. returns are not in anyone's hands, right? Returns are a collective thing that will happen over a period of time. But the very interesting thing that a lot of these people did is they believed that whatever we are going to do or whatever projections we are going to do will happen. So yes, there is one part of knowledge, that the stock market is good, India is doing well, GDP is going to rise, corporate India is doing well. So when we invest in the stock market, things will, we'll get money, things will work out well for us. Also on the other side, when we invested in products, so when we invested in fixed income products, that we will continue getting this 8% over the next 8 or 10 years, that happened. Okay, so there was also this belief factor that whatever goals I'm setting myself for will happen. There was a lot of faith, there was a lot of hope along with the faith. And that is something which goes beyond this Newton's law, that, whatever happens will continue to happen. If I didn't make money, if my father didn't make money in the stock market, I will also not make money in the stock market. Or, my astrologer says that this is not really working out for me, so I will not do that. But it's one of the best investments in terms of return generating capability, because everybody at the same time cannot have the same problems financially or structurally. What happens is this gets alienated, this part of investment gets away from us, which we don't control, and there are professionals managing it, whether it's a fixed income or whether it's the equity market. But we only have the knowledge and the hope and the faith that things will work out. And actually, it's very funny, I will write a lot more in detail about how exactly step by step this thing happened. But this did really work out. This did actually happen. And we're actually seeing that. So, and I'm sure my team will agree with me, there are some people who will always have funds. Their portfolios will always do well. And there are some people whose portfolios, will do okay. Then they will pull out something. Then they'll feel, okay, it's not doing well. Let me just pull it out. Let me go somewhere else. Then they'll do something else. Then they'll try something else. So they have the money. They have the income earning capability. But their money never really multiplies because their capital itself is fluctuating. Forget about their corpus fluctuating. The capital is in and out because of, I would not say lack of knowledge. They have all the knowledge in the world. Everybody is very intelligent these days. But it is just the belief system that this is not going to work. This has not worked for so many guys. This has not worked for my friends. This has not worked for my family. It's not going to work. I don't want to do investment. Let me just put the money in real estate and figure out what to do from the rental incomes. And when I need, I'll sell properties, So we have very, very different conceptions about how things work. But the people who've made the highest amount of money, and by far, I don't even need to prove that when we talk about the stock market, the index does about 14 to 15% compounded over a 20-year period. So, then every other investment starts looking really, really small and shallow versus this. Can we start the presentation, please? All right, okay. So now let's say, we spoke about the impact between PPF, or when I say PPF, I actually mean all the debt products together, PPF, bonds, fixed income, insurance policies, everything put together. And versus that, we saw the impact of what a mutual fund investment can do for you, or basically not a mutual fund, let's say an equity investment, whether you're doing shares directly or a mutual fund or a PMS or an AIF, doesn't matter. The category is important. So how that actually makes great returns for you, right? So we spoke about that. Then I showed you my daughter's portfolio that, we have actually lived this thing. Now, what we are showing you is, let's say we have a wedding plan. I mean, that's another very important need that we have for our kids, right, over a period of time. Now, again, to just get a sense of whether these investments will work. This is just a whole host of investment research that we've done. Value Research is a free website. You can have a look at it yourself. We've just blanked out the names of these funds for obvious reasons. But look at the 20-year performance, COVID. Now, look at this 20-year. Fabulous, isn't it? 23. But let's sort of look at it. I mean, there are lots of them. They just kind of keep going on. And there are the number of funds and the number of schemes are so many in India. But if on a 10-year basis, I'm getting a 22% return or 21% return, even if I look at a 10-year basis, I'm getting a 17%, 15%. But the important thing is, in this 20-year period, everything has happened, right? We've had wars also. We've had economic calamities. We've had biological hazards like COVID. We've had all sorts of problems that you can think about. In fact, 20 years is a period which is just, we've even had the terrorist attacks, of 2002 in America. Everything happened. Despite that, these kind of corpuses were created. So this is public data. We have lived it, and the impact is humongous, as we saw from the two variations of that chart which I showed, where the PPF in the mutual fund is huge. Now the disparity is massive. So it's our choice that we get into this and then we stay with this thing with the belief that these things will work out. So a lot of people, a lot of times tell me that yeah, what has happened in the last 20 years may not happen again. So the like yesterday I was talking to somebody and we were talking of a blue chip bank, where we said that, okay, this bank has performed so beautifully. It has multiplied almost 20 times in the last, or some 17 times in the last 10 years or the last 15 years. But how likely is it that it's going to happen again? Now, that's anybody's guess, right? We don't have an answer to that. If that bank doesn't do, some other bank will come and do it. But as a category of investment, if you are into banking and financial services, then we know that we have a long way to go. We have a long way to cover our own country. And a lot of times, about 20, 30 years is more than enough for our entire lifetime and the lifetime of our kids the next 20 years for making these kind of things happen and making these kind of investments actually bear fruit over a period of time. So with that, can we move forward, please? Okay. Now, before we actually go into this area of Kalpavruksha and creating a money tree, what I want to do is, Jhaveri, can you show us that education plan template? Because inflation is so severe and there are so many things that hit us. We don't have all the answers. We do not know what's going to happen in the next 10 years, 15 years. We don't know where our funds will be, what projections will we have, whether we will have enough or not enough and things like that. So this is a little bit of a tool that we have made here. And what we have done is we've made obviously some very basic assumptions. We have assumed that, let's say we have a kid age of 10. Some of you have seen it. The ones who haven't seen it, please stop me. And there are a lot of numbers on the screen, but I'll take you through these very, very slowly so that you can actually appreciate the essence of what we have done here. So, like I said, some simple assumptions. This year is 2023. We have taken 10% as sort of the age. Can you please make this 12% for the time being? Okay, thank you. So we've taken a 12% rate of growth on our money. We're doing a very simple thing, which a lot of us do. Let us say we are just having some 15 lakhs of money right now, which we are going to invest on a monthly basis. Approximately a lakh and 25 is something that we are going to do. We have just made that as a simple assumption. In fact, can you just make this 0 first for the time being? Just make this, just make it 0 for the time being. Okay, let's sort of start right from. So what we are doing and what we are showing is exactly how can you go planning for education in the most simple and yet most effective sort of a manner. Please ignore all these other things, retirement, because this is like a general calculator that we have. So let us say my child is 10 years old today. Okay, we are in 2023. Now, at age 10, typically the child will be in standard 4. So I know that the milestone will come at standard 10, where I might need to spend a little bit extra money, maybe for tuition, maybe for classes, maybe for some other activities. Again, like I said, this is just a guideline milestone. These numbers can be changed. You can tell us what to do and we just do it on the fly right now if you want to see a simulation. Okay, but first let's just go through this in the next 2-3 minutes. So let's assume that I will spend 2 lakhs, but this 2 lakh estimate is obviously incorrect, because if my child was in standard 10 today, and if the child was age 16 today, then maybe the cost estimate of 2 lakhs is a fair estimate. But what's going to happen is this is actually going to happen after a period of 6 years, correct? So I need to naturally inflate this money. So then the 2 lakhs of today at an inflation rate of, where's inflation here? There is inflation. This is 6% inflation, okay? So at a 6% inflation, say this figure works out to 283. Okay. So that is how we have created this sheet. I'll just remove some of the markings again. So then standard 12 is the next milestone, which is at age 18. Again, let us say in standard 12, I'm going to spend another 2 lakhs. Let's say my child wants to go international, to pursue some international education, 4 years of undergraduate education. these estimates are typically estimates of education that I see today happening in US and UK, largely the preferred destinations, Australia, Singapore, a little cheaper than this. But let's say 50 lakhs is a reasonable figure. If some of you think it's, needs to be changed, please just give me a shout and we'll just change it. But we've taken 50 lakhs as an estimate, okay? 50 lakhs for each year. Fair? So obviously this 50 lakhs is going to happen after about 9 years. This will happen after 10 years, so on and so forth. So correspondingly, the inflation rates are kind of increasing those budgets. So today, if I think that my budget is, say, about 2 crores for undergraduate education, actually, I will end up spending almost to the tune of what, 1, 2, 3, 4, almost 3.75 crores if I look at these four numbers together. So, and it's a little scary. It's a little it makes us nervous a little bit, if you like, but it's not so difficult to, tide over this thing and achieve this thing. And I'll just show you that in a couple of moments. Same way we have assumed postgraduate education, whereas let's say again, we are spending 50 lakhs a year, and correspondingly in future, the value is almost double because it's about 10, 12 years ahead. And let's say, when my child is of age 26, give or take, maybe I'll have to spend some amount of money for wedding. And let's say I've taken a figure of about 1 crore for that. So the future value of that works out to almost 2.45 or 2.54 crores. So these are my raw materials, if I like. So this little calculator has told me that at 6% inflation, these are all my future values. So goal amount in future, goal amount today, and this is at 6% inflation, right? So what are the amounts that I'm going to actually need? Can you please total this entire sum of figures, please? So that works out to almost 8.5 crores. So what I need for one child to do these things, and of course, we've not taken schooling into the consideration, but let's say it's estimated it's going to cost us about 8.5 crores. And how will we now go towards this 8.5 crores? Okay. So first, let's do what we all do. Let's make this as a 7% rate, because we buy insurance policies, we do PPF, we buy Sukanya Samruddhi, we buy, all these products, which we think we are doing for our children, and that should give them prosperity over a period of time. All right. Okay. So the corpus position of 50 lakhs, can you just make this also zero? Because let's say we're just starting right now. So can you just sort of, no, keep this, keep that 2 crores in, because that was the previous formula. Just remove the 50 lakhs from the, yes, please. Thank you. All right. So this is zero. So this is like a clean slate, and we're starting here. So what do we typically do? Let's say we're going to do an SIP of, or for that matter, a PPF investment, because now this is a 7%, or we have done an insurance policy. So say we are doing 25,000, just put 25,000 into 12, and that's our investment. Let's say we are doing this kind of an investment. Is this a fair number, friends? I mean, is this making sense so far? Is everything good? Clear easy to understand?
Yes.
Okay, fair. Please, yeah, this is like a interactive thing. Okay, so if there's any sort of a thing, this is like the heart of the talk today. This is like the core. This is the engine, if you like, in terms of what we should do. After this, of course, I'm going to show you one of the other solutions that I've implemented, which creates stability and all of that. But so let's say, we invest about 3 lakhs for our child in a year, and typically in a very, very safe and secure kind of a product. And we think that, everything will happen, and it's like absolute reality. So if we are doing this, assuming that you're doing this, constantly, this corpus position is now the number to see. So you've done 3 lakhs. Obviously, in the first year, it's only 3 lakhs. The next year, you put in 3 lakhs, and your previous year's 3 lakhs has earned some money. And that's how it's become 642, right? This part has earned 7%, this guy. And this is, of course, like a new investment for the year. And so on and so forth, your corpus starts moving up. Now, when your corpus is moving up, see what happens. You just come here, and in about, let's say, 8 years' time, when your child is 18, you have built about 30 lakhs. But then the child wants to go abroad, or there's some other expenditure that needs to come. Your corpus is suddenly not only zero, but it's negative. So you don't have enough money. So what we need to do is we need to obviously keep pumping in more money, either in investments or there is this tremendous pressure on earning more money, and then stress and where to change the job and what to do and how to do. Okay, now let's make it a slightly more uh, entrepreneurial or slightly more enterprising sort of a situation. Let us say that we till date have say about 50 lakhs of investments and savings that we've done over the years. Okay. So what I'm going to ask Zari to do is I'm going to just ask him to add 50 lakhs here. So this is our starting point, okay, for all our savings. Say we've got 50 lakhs. Okay. So if we had 50 lakhs to begin with, okay, and then we were doing this 25,000 every month, not a SIP, but into a policy which was going to give us 7% or something like a combination of PPF and Sukanya, etc. Okay, we are still going to get busted within about 2 years or 3 years of the education need of the child, and our corpus becomes negative again very quickly. We are hardly able to fulfill expenditures, and I think these days a lot of us think that uh, foreign education might be good. I think Indian education is fantastic, no doubt about it. But then sometimes it's peer pressure, sometimes it's our own expectations, sometimes it's what the kids want. But we like to be prepared for it. So if we save it, fantastic. But if we have to spend it, then we need to be ready and prepared. So obviously, as you can see, 7% doesn't cut it. It doesn't make sense. So we have to depart from this idea, do something else. So therefore, let's say we make it 12. We know for a fact that the world of equities gives us much better than 12. 14, 15 is kind of realistic. I just showed it to you that it's possible. We have lived it, got it. And I think we will continue to get it without problem. But let's be very conservative. Let's take 12. Can you please change it? So at 12, it still is not helping. Can you see 50 lakhs corpus and it's not helping me. So what happens then? Very often we start deploying our resources of retirement and everything else to this area. And therefore, let's sort of now make this SIP as, a lakh and 25. Let's for example, add a lakh here. Because then, priority for us is obviously this education, that we need to make education happen first, because everything else, I will figure out. Maybe I'll get another job. Maybe I'll continue working till 65. Maybe I'll continue my business, whatever the case is, but it's just not going to cut it. So there we are, still sort of not working. See, please remember, this is a simulation, right? This is not an example where I'm saying that we have 50 lakhs and we're doing a lakh and 25. It's just a simulation. Let's say this is what I have. And we are only exploring what can happen and what can't happen, right? So at 12% return with 50 lakhs of corpus and doing a lakh and 25, we are still sort of not able to fund this thing. But we have reasonably finished with undergraduate education. Maybe we can choose and say, tell our kid that, post-grad education you figure out, because now I can't give you further money. Okay. Or we can think about, doing a little bit of a change. And this is where the belief factor comes in. Okay. So this is where the trust factor, the hope factor, the faith factor comes in. That, we will be in a good country, everything will be good. Incidentally, last night I happened to meet another fund manager at another social event, and very popular company, worldwide presence and all of that. And they were saying that for the last 10 or 11 years of their existence, they have delivered to their clients almost 11.2% returns in US dollar terms, which is fabulous, right? 10 years time. So 10 years, if you look at what was our rupee to US dollar to rupee exchange rate, today we are at about 82, 83. 10 years ago, I don't have an exact number, but I'm guessing that we should have been somewhere in the range of about 50, 55, thereabouts. Just do a quick check, Zari, so that we have the exact number behind. But
in 2012, it was 55.
Okay, so there we go. Thank you, Anil Bhai. That is really helpful. So we have almost kind of depreciated by 60% over that. So if you depreciate an 11% return by 60%, you add about 5.5% to it. Then in rupee terms, they have done about 16.5%. The same fund manager that I'm talking about. So this language is very common between all investment professionals like us. US dollar terms, 8 to 10, 11% compounded. Indian rupee terms, about 16%, because obviously one side is depreciation, other side is inflation, other side is GDP growth. A slightly technical kind of language, but in a sense, to make it very simple, US dollar terms doing 10, 11%, Indian rupee terms, we are doing 16%. It's quite possible. And we are still growing. We still have a lot of growth to go. So we can safely believe that this 12, 14 should actually materialize. So, sorry, now let's make this thing 14. Okay. And let's try and see that with this much budget and this much investment, everything, we are able to more or less take care of the child's need. And the only thing that we have to compromise a little bit is on the wedding part. So wedding, we were at 2.5, and now we are just running a little deficit of 125. Sometime back, Lokesh, you asked me what happens if COVID strikes, right? So what happens is now these 14% in equity market are never linear. The equity market, like I said, the returns sort of go like that, and they do this, but this is normally the path. Equity returns have never been like that. They don't go down. You see what I mean? They don't go down this way. The general trend for an equity return is this way. It goes upwards, but it doesn't go upwards in a linear fashion. It sort of goes up and down. And that is where there's a very interesting thing that in the investment world, which we call as allocation and rebalancing. And that little bit of reallocation balancing happens. So let us say if your goal was in 2023, and if you already feel that you made a reasonable return by 2018 or 19, we can actually take a lot of money out of equity and just park it in a fixed deposit. So that way you protect even that, because of that rebalancing, you sort of protect any eventuality that might happen in future. So
Kartik, in a little lighter note,
yeah,
if doing such wonderful investments and making sure that he's a postgraduate,
yes.
we are only short for his marriage. The easier way is to find out a rich father-in-law.
Yes, absolutely. I mean, whichever way you look at it. So I mean, I really have, a lot of times my daughter tells me that, maybe I have to find a rich guy to fund all my lifestyle. So this is how it works. But anyway, so having said that, do you get the essence of what we are trying to do here? This is like a live simulation. A lot of you have already seen it. A lot of you who would like to participate, just let us know subsequently. Jhaveri will put up a little number to contact us if you need help with this kind of a template. We'll be happy to share it with you as at a later date, okay, after we are done with this session. So let me sort of clear this. Now, having said this, at this point, I want to take you to another very interesting solution. Now, most of you who know me as a pure equity sort of a person. I'm perpetually bullish. I always think the equity market is going to make great returns for us, right? And which it has. I mean, I have actually lived this for the last 30 years and 20 years professionally. But here is something very interesting, which I did, very different from my usual character. And I did this for my daughters, and that is exactly what Jhaveri will just show you. Is like, can you put up the financial stability and that creating a money tree, what we call as a Kalpavruksha. Kalpavruksha is a wish-bearing tree from our ancient scriptures. And so this solution, this is not a product, it's a combination of products. It's a solution. So can you just put it up, please, for us? So it's a little bit of a product where you make some investment, and the investment example here. This is not really an example. This is my example. So 10 lakhs I'm going to invest for 10 years. Okay, I'm going to try and grow a money tree for my girls. It's going to get watered every year. These are the cash flows that they are going to get in their hand. Okay, from the 10th year onwards, this is what they get. Okay, 28. From there, this is their age. Okay, so let's say if my child is 10 years old, these are going to be her future cash flows. Okay, continue please. Very nice. Okay, yes, by the way, very important, the word, I don't know if you've caught this, tax-free. This is all tax-free. Okay, tax-free even in today's world, as much as now, because I started this thing last year, and this is all tax-free. So 10th year onwards, 6 lakhs, all the way every year till her age of 50. Then from 50th year, 28 lakhs every year. From the 55th year for the rest of her life, 1.2 crores. And this actually goes up by an inflation rate of about 2 or 3%, which we couldn't show here. But this is the cash flow. This is per year cash flow, by the way, all these cash flows. At her 85th year, maybe some legacy of 14. Okay. And total of all this cash flows through her lifetime is going to be a value of about 56. Now that's because my child right now is 10 years old, one of them, the younger one. Okay. So if the child is 2 or 3 years old, this number of 56 can easily become about 70 or 80. I mean, just imagine. So even if you want to budget for inflation and things like that, what will inflation do? And what will be the value of 1 crore, say maybe 30 or 40 years down the line? It's going to be equal to at least 10 or 12, 10 or 12, 15 odd lakhs of today, which means your child will have enough pocket money. This is not going to take care of a lifestyle, but this is, let's say this is pocket money, or this is money that will help us sustain if everything goes away. So this is like end of the world kind of a planning, where the person is financially stable and never has to ask for money, and everything is automated and created from now. So the child did not do anything, all this is available. However, if the child was very clever, very, very smart, financially astute, brilliant in his or her own financial management, and whenever let's say the child becomes 20 or 25 years old, let's say she's very clever, 25 or 30 years old, and she says, okay, my dad has done all this, but I can do better than that. You can just press one button. And you can completely exit this whole thing. So it's completely liquid also. It's like a super liquid situation. And after the 10th year, there is absolutely no problem pulling anything out from anywhere. So it's actually super liquid. Even before the 10th year, you can pull out if you needed to. But as most of you know me, whatever I do, I like liquidity as a very important part of my planning or my understanding or appreciation of financial products. So for me, it's very, very important that there is liquidity. There is always a better option available. And if I do find it, then I should be able to take advantage of that. That's been my principle. So which is why I like everything that is easily accessible and easily changeable. All right. So now this is a pictorial representation. Let me show you the same thing in a slightly different format. And for that, can you take me to the next one? So this is exactly how this concept works. Okay, this is how I can plan legacy and financial stability. And like I said, it's liquid, so I can do whatever I want with this. This is a combination of some products, if you like. So what I'm doing is at time zero, let's say in 2023, this is my investment, right? I'm making a 10L investment. 10 lakhs is my investment, as you can see. In the next year, which is 2024, again, I will make a 10 lakh investment because I need to invest for 10 years. Remember the previous slide? Can you just take us back to the previous one, please? Just for a moment. I said the investment plan that I did was 10 lakhs for 10 years. See, I don't like to take a very, very long commitment of 30 years and 40 years. So whatever we do, we produce it in terms of deployment, we produce it now because from our earning years, we just do this for our children and put it aside. Okay, come down, please. Yeah. Okay, so basically first year, second year. But now this is the beauty of this solution. I have invested now, please, everyone, just give me your 100% attention for the next 2 minutes. Okay, you have to understand this concept. I was absolutely thrilled by it. And like I said, I'm a pure equity person, perpetually bullish and 100% equity oriented investor. That's my profile. But I liked this one. And I'll tell you why I liked it, because of this. Can you see this little arrow? So I have put in 10 lakhs today at, say, June of 23. In June of 24, I will get a 2.5 lakh inflow. Look at this. This is inflow. This is my outflow negative. This is my inflow positive. This is what I'm going to get immediately in 1 year's time. Okay. The other thing which was driving or which was sort of playing at the back of my mind was that I'm managing money. I'm doing, investments for our family. I'm doing whatever I need to do. But what if my children choose a different career, and which they in all probability would, right? It would be same with your children as well. What if they are not financially so connected with investments? So should I not have something which is automatic, which works on autopilot without their slightest of involvement? So this is exactly that kind of a thing. So this money flows into their bank account on their birthdays, and this is the cash flow that comes in. I mean, of course, we can program it to flow on their birthdays, but essentially in a year's time, this is what I get. Then I make my investment again for the second year and the third year, so on and so forth. And every year I'm getting this payout of 2.5 from the very, very first year itself. Okay. Now, here's another trick which we used. This cash flows the first 10 years that I'm getting, okay, all this money is basically 2.5 every year. So 2.5 into 10 becomes 25 lakhs, right? This 25 lakhs, I have rotated into equity. And this initial investment is all happening and guaranteed at 6% and bonuses at 8%. So this is very conservative, kind of a simple fixed deposit kind of an investment. Okay. Of course, this is happening, you may have guessed, because you see the word bonus and you figure this is happening through an insurance policy, because they are the only ones who can give you these guarantees and stuff like that, right? Nobody else can give guarantees except fixed deposits and some insurance policies. So basically, outflows negative, inflows positive. In a 10-year period, we are going to do 10, 10, 10. And then, of course, from the year 3 to 10, we've just put it in one single cell here, one single box, 70 plus 30. My total investment being 100, 10 lakhs, 10 years. Okay, that's all I have to invest. But these are the cash flows. First year, 2.5, second year, 2.5. For the next 7 years, again, 2.5 every year. Basically, for the first 10 years, 2.5 lakhs every single year, which I am not going to let them have access to, because I will still be in control of this money, which I'm diverting into equity. Okay, and then expecting to earn 12. So the essence is that this 25 will become a really large amount of money, almost about 15 odd crores or so by her age of 56. It's like many years into the future, right? And then I'm just withdrawing about a 9-10% from here. And that's how she's getting this 1.25 lakh crore cash flow every year. Right from the time she needs it, say during her the age from 50, 55 upwards to the rest of her life. But in a sense, these are the cash flows. Do they make sense? Is there any question? Are these easy to and clear to understand? Not easy, rather clear. Any questions on this before I sort of move? Anyone?
Okay. Kartik, this is Anand. So the 10 lakh cash flows that we are, outflow that we are looking at.
Yes.
Now, and the 2.5, it obviously depends on the amount that we are able to invest every year, right?
Yeah. Of course. I mean, if this is like, sorry to jump, but if this is 5, this is all half. I mean, everything reduces.
Yeah. Understood. Yeah. Okay.
So yes, I mean, if we do, but you see, there is a limitation now, unfortunately, from this year, Anand, that we can only have this solution for a maximum of the number 10. If we are even willing to invest more than this, it becomes taxable. That's the problem.
Okay.
I mean, we will have the same cash flows and everything, okay, in future. But what will happen is then this 6% and 8% also becomes taxable. So, and it becomes taxable based on our income tax slab. And if we are in the 35% slab, imagine you losing another. So this product is about 6.5% as an average kind of a thing. So if you lose a 35% out of that, then this does not become a viable investment. It does not become financially a very clever investment to do. Because if you're going to, at the end of it, earn 3.5%, you're better off with a saving account. This only with the current amendments that were made in the budget of this year, all these products also started becoming taxable above an investment limit of, above certain investment limits. I don't want to get into that, but this solution only works with a maximum of 10. We can't do more than that, even if you want to. To get
less than that is okay, right?
To get it tax free. But see, this is also something which is available for now. And we don't know what's going to happen in budget 2024. This also might be taken away. This also might go. We are very gradually and steadily moving to a financial regime of taxation where everything is taxed. There's nothing called deduction. There's nothing called exemptions. There's nothing called tax free. So maybe our children will not even understand the word tax free. But today we have a little bit of tax free. We are probably at the last phase of this tax free. Maybe a year, maybe 2 years. Already we know that from this year, income tax filing from this year, whatever goes into the new regime, that's going to be the default regime. And there is no deduction in that regime, right? So whatever you earn is taxed. And that's exactly what is happening. So this is the last little opportunity, maybe till March 24, or one doesn't know if they decide to bring out a circular or notification in the middle of the financial year, even that's possible. So that's that. Yeah. Just a second, just clear. Okay, so these are my cash flows, as you can see, 25, just to repeat, 2.5 lakhs every year. Then the 11th year, like I said, 6 lakhs every year, 30 lakhs. Can you just go back to the previous slide? So this is the cash flow that the child can enjoy, which I will try and impress upon them to use it wisely, whether they want to spend it or whether they want to buy things out of this, whether they want to fund something, whether they want to save it. It's all up to them. But these cash flows are constant, steady, and they will keep coming no matter what. So this every year falls into the account. This every year comes into the account. So the beautiful thing about this solution was the liquidity factor and the fact that cash flows are continuously coming in. So we can do a lot of things with cash flows where I'm not stuck with a 6% like an LIC kind of a product where I put in some money, and even if it is 6%, I'm going to get it at the end of the rainbow, which is after 20 or 30 years. So instead of that, these solutions are providing me cash flows instantly and immediately. So which is why I got an immediate liking to this kind of a solution, and that's why I implemented this. Okay, we can move forward.
So Kartik, what was this? Investment vehicle. What was the name of this?
Can you
Sorry?
stop this presentation, please? So, and can you also stop the streaming, because we're just doing Q&A now. So just give me a moment.